Right, so let's look at the second approach in relation to calculating duration. And so when we are looking at the second approach in relation to calculating duration, what we said is that when we are calculating duration from present, taking into consideration the present value of the project. So let me quickly refresh you on what we did under the initial investment. What we said was that 4 steps. So the first step was that we discount the cash flows at the internal rate of return of the company. Second, we look at the present value, or we take the net present value or the present value as a proportion of the initial outlay. So we use the initial outlay out. Then from there, the third step is that we use the period to multiply the ratio. So year 1 was used to multiply 1, year 2 we use the to multiply 2, year 3 we will multiply 3, and then the 4th year we added or summed up the totals that we had there, and that gave us the weighted average period, and that was the duration. Now, if we are calculating the duration looking at the present value of the project, still we're going to go with 4 steps, and I discussed it in the previous video, but I'm going to go through it shortly again. First, we said that we calculate the present value of each future cash flows at the chosen hurdle rate or at the company's cost of capital. So this time around, we are not finding the present value using internal rate of return. We are finding the present value using the company's cost of capital, or what we call the hurdle rate. Very, very important to get a distinction. Second, 2, calculate each year's discounted cash flows as a proportion of the present value of total cash flows. So this time around, we will use present value over total cash flows of the project, not over the initial investment as we did in the first one. That's another distinction of the 2 approaches. Third, take the time period of each discounted cash flows and multiply it by the respective proportion, as you know already from the previous step. And then 4, you sum up to get a weighted average method, or to get a weighted average values, and that becomes the duration. So these are the 4 steps we go through. There are 2 distinctions that you need to look out for. So let's look at an example. The forecast cash flows relating to a project are, so we've been given the initial cash flow 34,000. So I think the question is just the same as the previous one, but this time around, establish the duration based upon recovering the present value of the project using a discount rate of 8%. So we are calculating the duration, but we are basing it upon recovering the present value of the project, and we are using a discount rate of 8%. Remember, when we are doing the initial investment approach, that one will be giving the internal rate of return. But if you are recovering the present value, then we will use the hurdle rate or the company's cost of capital, which has been given to us here as 8%. So let's see how we go about it. The same approach as we did previously. So step 1, we need to calculate the present value of the cash flows, and we are giving the present values of the cash flows. Year 1 is 7,600 divided by 1.08, and that will be exponent 1, right? Because it's 8%. Year 2 is 16,500, and that will be still 1.08, but this time around exponent 2. Year 3 is 13,000, and that will be 1.08, this time around exponent 3. And then year 4 is 6,600, and that will be 1.08, but this time around exponent 4. So that is how we calculate the present value. When we kick it out, we're going to get respectively something as, let me see what we have here, 70. So the first one is 7037. This one is 14146. This one is 10320, and this one is 4851. So these are the present values. Then the step 2 is calculate each year's discounted cash flows as a proportion of the present value of total cash inflows. So we need to get total cash inflows. Okay, so sigma present value. So when we add all these 4 up, we will get 36,354. 36,354. That is it. And we're going to be using that to do step 2. So when it comes to step 2, we take, what do we take? We take this 7037 over 36,354. This will be 14,146 over 36,354. This will be 10,320 over 36,354. And then the last one will be 4,851 over 36,354. Sounds good. So this is how we do the thing. So this time around, you see that we are dividing with the total present value and not the initial investment, as we did when we are recovering the initial investment. Step 3 says take the time. So let's see the answers that we have in relation to that. When we do the division, this should give us something like 0.194 if we do the workings. This should give us 0.389. This should be 0.194, and the last one should be 0.133. So that is it about that. Then the step 3 says take the time period of each discounted cash flows and multiply by the respected proportion or respective proportion. So if you check, this year 1 will multiply this, so this will be 0.194 times 1. This will be 0.389 times 2. This will be 0.194 times 3. And this will be 0.133 times 4. So that is it. Then we need to get the answers up there. This will be 0.194. This times 2 should give us 0.778. This times 3 should give us 0.852. And that times that should give us 0.534. So that is the third approach. Then the final approach is you sum up, and that will give us the weighted average period, and that's the duration. So it should be 0.194 plus 0.778 plus 0.854 plus 0.534. So when we add all these up, that gives us our duration, and that should be 2.358 years. You see that it's almost equal to the first one. The first one was 2.332, and this is 2.358 years. So this is how duration is calculated. So it's very important for you to understand how the calculation is done. So the question we have to ask when it comes to duration is, are we recovering the initial investment? If we are recovering the initial investment, 1, we need to work with the internal rate of return, and 2, we need to do our ratio taking into consideration the initial capital outlay. But if we are recovering the present value, then 1, we need to take into consideration the company's cost of capital, and 2, we need to get our ratios using the total present value of the project. And these are the 4 steps we go through in calculating our duration. So I hope you understand the concept of these techniques under the advanced investment appraisal, in the modified internal rate of return, in the discounted payback period, and very importantly in relation to the duration. These are all techniques that we can use to appraise the project. Again, when it comes to the duration here, you realize that we cannot just calculate the duration and then make any decision, okay? So it has to be compared against the company's duration that they have set, the average time that they have set for themselves, and as we did in payback, if whatever you had here is more than what has been fixed or has been agreed by the company, then we reject the project. But if it is less, then we accept the project in relation to that. So that is what you need to understand when we talk about duration, and also when we talk about calculating or using the advanced techniques in calculating or determining whether we should accept a project or not. So these are the techniques that you need to understand. So in total, we've done about 7 techniques that you need to understand. We looked at the accounting rate of return. We looked at the payback period. We considered the net present value. Then we considered the internal rate of return. Then we came to modified internal rate of return, discounted payback, and then duration. So these are 7 techniques that we used in relation to having an understanding and appraising a project. Now the next thing we want to look at is the concept of free cash flows. The concept of free cash flows. Now the concept of free cash flows must be understood from 2 views. We have what we call free cash flow to the firm and free cash flow to equity. Now when we use the word free cash flows, it simply means that how much money that is available to the business to pay its finance providers. That is free cash flow. So in other words, if we take the business today, if we look at how much the business has, and you look at if the company should pay whatever it has to pay in relation to projects that they want to undertake, how much money is left that it can give to the providers of finance, and that is what we refer to as free cash flow, meaning we've paid whatever it has to be paid, and this is what is left that we can freely give out to the providers of finance, and that will not affect our profitability as a company. So we have what we call free cash flow to firm and free cash flow to equity. Now, so their names will help us. When we say free cash flow to firm, it means that how much money that is available to be paid to the providers of finance, both debt holders and then equity shareholders. So that is to the firm. It includes if our capital structure is equity and debt, then definitely free cash flow to firm is how much money is available to be given out to people who have given money to the business, both the debt holders and then equity shareholders. But free cash flow to equity, as the name suggests, is the amount of money that is available to the owners of the business. So amount of money that is distributable, that we can pay, available to be paid to the shareholders of the business. In doing this and in understanding the concept of free cash flows, we need to also understand 2 things. One, that we will be using the present value concept here, and we'll be making some assumptions here, whether there is growth or there is no growth. So it's like we are going back to business finance here. Now, when we are using the concept of free cash flow and calculating, we will look at the cash flows divided by KE, and you know KE is the company's cost of capital. Now, so when we are finding the present value of free cash flow, now why is free cash flow important? Because you see, we will be using the free cash flows much later on. One, the concept of free cash flows is important for us to place a value on a business. So we use it in business valuation, and also the concept of free cash flow will be valuable when we are appraising a project and taking a decision about the financial status of the company as well. So with this one, we assume there is no growth. So meaning that we are going to have a constant free cash flow. So maybe for the next 5 years, we will have a constant cash flow of 5,000, 5,000, 5,000. That is the no growth concept. But where there is growth, we say that the present value will be equal to the cash flows 1 plus G over KE minus G. So this is where we assume there is what? Constant growth. So the second one is where we assume there is constant growth. So where we assume there is constant growth, then we break the cash flows, we put in the growth, which is the G, which you know already, then we get our present value of the free cash flows. So let us find out how we can actually calculate free cash flow to firm and free cash flow to equity. Now there are approaches that we have to use, procedure that we follow, or a pro forma that we follow in calculating these. So the first one we want to look at is the free cash flow to firm. How we calculate free cash flow to firm. Now, if we are calculating free cash flow to firm, we use the layout below. So free cash flow to firm, we can put narration here or item here. So we will bring earnings before interest and tax. Then we will less the tax on the earnings before interest and tax. That will be subtracted, very important. So earnings before interest and tax is like profit before interest and tax. Then we will subtract the tax from it. Then we will add non-cash item. Now when we say non-cash items, we're talking about issues such as depreciation, issues such as amortizations, issues such as provisions. Okay, these are non-cash items. Remember, they were taken into consideration in arriving at the earnings before interest and tax. So when we are calculating the concept of free cash flow, we need to come and add it back, because non-cash flows are non-cash flows. So we need to come and add it back. Then we will less any capital expenditure we want to undertake, capex. So any capital expenditure we want to undertake, we less it from it. Then we take into consideration working capital. So when there is going to be any decrease in working capital for the future, we add it back. So when our working capital is decreasing, it's money coming into the business. But we will less increase in working capital. If the working capital is increasing, meaning more money is going out of the business. Then we will add scrap value of assets. If there is any asset we're going to be selling, we'll add a scrap value of the asset. So that is what you need to understand in relation to that. I want to make sure I break all the items. 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7. So sum it up, and that gives us the free cash flows to the firm. So that is the layout on how we calculate the free cash flows. So we bring the earnings before interest and tax, we less the tax, we add back any depreciation, amortization that is in the question, we less any capital expenditure the company intends to incur. If there is a decrease in working capital, now remember, these two will not be the same there. It will either be a decrease or an increase. Whatever it is, we treat it. If it's a decrease, it's an inflow, we add it. If it's an increase, it's an outflow, we subtract it. Then if there is any scrap value, any asset we will be selling during the period, that is a cash that is coming in, so we add it back to our earnings, and that gives us a free cash flow to the firm. So let's look at an example on how we can calculate the free cash flow to the firm, since we have the pro forma laid out here. So example, Nhyira PLC has earnings before interest and tax of 2 million or 225,000 pounds. So 225,000 pounds for the current year. Depreciation charges for the year were 15,000 pounds, and working capital has increased by 2,500. The company needs to invest 22,500 to acquire non-current assets, and profits are taxed at 30%. Required. Calculate the free cash flow to firm. So we've been given the things in the question. So since my pro forma is here, I'm just going to be cleaning and putting them in. So Nhyira Limited has earnings before interest and tax of 225,000. So that's the earnings before interest and tax. Then we said less tax on the earnings. We are told that the company pays a tax of 30%. So clean this up. Less tax at 30%. So 30% of this figure, that gives us 67,500. So we less it. Then from our pro forma, we say add any non-cash item. In the question, we were told that depreciation charge for the year was 15,000. So we will say add depreciation. That's 15,000. Then we said less capital expenditure. We are told that the company needs to invest 22,500 to acquire non-current assets. The company needs to invest 22,500 to acquire non-current assets. That is a capital expenditure. So what do? Less capex, 22,500. So we subtract it. Then from there we say add a decrease in working capital or less an increase in working capital. Remember I told you that these two will not be there. It's only one that will be there at a time. So from the question we are told that working capital has increased by 2,500. That means there is an increase in working capital. When there is an increase in working capital, we subtract. So clean this up here. And I say less increase in working capital. And that is 2,500. I less it up. Then from there we bring scrap value. We are told that, well, we're not told of any scrap value, so the company is not going to be selling off any assets. So boom, we are done. Very simple. So if you check it out, this is the free cash flow to the firm. So when we sum it up, we will get 147,500. Meaning, this is the money available to the company to pay to the finance providers for the period. That's it. Very simple, sweet, straight to the point. So that is what you need to understand about free cash flows to firm. Earnings before interest and tax, less your tax, add depreciation, less capital expenditure, less increase in working capital, and boom, sum them up, and that gives you your free cash flows to firm. So let's get a second one, free cash flows to equity, which is the money that can be distributed, okay, money that is available and can be distributed to the providers or to equity shareholders. Now, with the free cash flow to equity, there are two methods that we can use to calculate it. In other words, there are two ways that we can calculate the free cash flow to equity. We have what we call the indirect method, and then we have the direct method. And I'm going to go through the two for you so that you understand what we are talking about. So let me first put the pro forma down for the two. So free cash flows, equity, that's the second thing. So the first thing is the indirect method. And I'm going to do the direct method here, right? Now the indirect method is going to go this way. We will start with the free cash flow to the firm. Okay, we'll start with that. Then we will less net interest, now when we say net interest, we mean interest after tax. Now why are we lessing the net interest? Because you see, even though interest is tax deductible, we will not be paying that interest again, so the tax effect of that is what we are lessing here. So we less net interest, then we less loan repayment. Remember, you see, this thing is not about chewing anything, it's about understanding. If you need to find out how much money is available to equity shareholders, and you are starting with how much is available to both shareholders and debt holders, certainly you need to pay them off. So you need to look at how much must you pay, the loan that you have to pay to the people who the company owes. So loan repayments, definitely we less that out. Then during the year, if we are going to be issuing any loan, so we add issue of loan notes. Or debt, we add it because it's a cash flows. Then when we add them up, this will give us a free cash flow to equity. So this is the indirect method, where you are starting with the free cash flow to the firm. But this is not always the case for us, because almost always when we are calculating the free cash flow to equity, we don't have the free cash flow to firm. So we go to what we call the direct method, II. So when we come to using the direct method, what do we look out for? One, when it comes to using the direct method, the approach goes this way. We bring net income. Now when we say net income, we mean profit after tax. It means if we are giving profit before tax, we will have to less tax from it. So profit after tax. Then we add depreciation, because you know that is a non-cash item. Then we less capex, capital expenditure that has to be undertaken. We less it from it. Then decrease in working capital should be added. Then we will less increase in working capital. Sounds good. Then we add issues of debt, proceeds from issue of debt. We add it because money is coming in. Then we less any loan repayments. When we sum it up, free cash flow to the firm. And that is how we go about it. Sorry, to equity. Free cash flow to equity, not to the firm. So that is what you need to understand. We have the indirect method where we start with the free cash flow to firm, and then we have the direct method where we start with profit after tax. If the examiner gives us profit before tax, we need to less the tax from it. Then we get a profit after tax, add back depreciation, less your capex, and then working capital, if it is decreasing, you add it. If it is increasing, you subtract it. Then any issue of debt, you add it. Any repayment of debt, you subtract it. Then you will get your figure there. So let's look at an illustration and see how we can calculate the free cash flow to the firm and free cash flow to equity in relation to that. So Poshira Limited income statement for the year ended 2010 is as follows. So we have revenue of we are working in £1,000,000. So revenue is 1950, cost of sales is 1314. We get a gross profit of 636. We less operating expenses of 323, and that gives us operating profit, that is earnings before interest and tax, as 313. We get interest of 24. Profit before tax is 283. Then we get a tax of 35%, that is 101. So the profit after tax is 188. Then we have additional information. During the year, loan repayment or loan payments are expected to amount to £69 million with depreciation charge of £30 million and capital expenditure of £60 million required. Calculate the free cash flow to firm, II free cash flow to equity, using both the direct and indirect method. So I'm going to focus on the II, which is free cash flow to equity. But if we are calculating the free cash flow to firm, you know we will bring the earnings before interest and tax, and that will be 313, earnings before interest and tax. Then we calculate the tax rate, which is 35% of that, 110, and then we will add back the depreciation of 30, and then we will less capital expenditure of 60, and that will give us a free cash flow to the firm of £173 million. Okay, that is how we calculate that one. But the II is free cash flow to equity, which is what I have on the board, and I'm going to walk you through that. Now, when we are using the indirect method to calculate the free cash flow to equity, then we are going to start with free cash flow to firm, which I mentioned that when we calculate we'll get 173. So we start with that 173. So when we start with that 173, the next thing we bring from our pro forma is to look out for net interest. That is the interest net of tax. Now, so if you check from the question, we are told that the interest is 24. So if we are bringing net interest of tax, or we are bringing net interest, all we say is 24 times 1 minus 0.35. 24, 1 minus 0.35. Okay, so when we do that workings, we are going to get 16. So we subtract that. That is how we calculate the net interest. Then we say loan repayment. Yes, in the question we were told that during the period loan repayments amount to 69 million. So we less that. Now during the period we are not told of any loan issue, so that will not be our problem here. So we add it up, and that will be the free cash flow to the firm, and that will be 87 million pounds. 87 million pounds. So that is the free cash flow to the firm using the indirect method. So we will be starting, free cash flow to equity using the indirect method. So we'll be starting with free cash flow to the firm, and then we go through. That's the indirect method. But if we are using the direct method, then how do we go about it? Remember, we start with net income, or the profit after tax. From the question, the profit after tax is 188. So we pick that up. Then we say add depreciation. From the question, we are told that depreciation is 30 million. So we add it up. Then we less capital expenditure. From the question, we are told that capital expenditure for the period is 60 million. So we less it. Remember, we are working in million. Then decrease or increase in working capital. From the question, we were not told about anything on working capital. So since we were not told anything about it, it will not come in our solution. Okay, it will not come. But we were not also given anything about issue of debt, but we were given loan repayment to be 69. So we bring that up. So we less loan repayment or loan payment. Let's go through loan payment. 69, and that will give us free cash flows to equity. I don't know why I'm sticking with firm. This is still equity, right? Forgive me. Free cash flow to equity. So free cash flow to equity, and that will be 89 million pounds. So if we use the direct method, realize that we are getting 89 million pounds. When we use the indirect method, we are getting 87 million pounds. So that is what you need to understand about the concept of free cash flow. Now we're going to take these things to another level later on in our studies when we are discussing other issues about it. But for now, you need to understand how they are calculated in relation to that. So this is what you need to understand about this segment of it. In the next video, we will be discussing or looking at other issues about risks and uncertainty, because you see, when it comes to projects, usually so far we've not been taking into consideration any risks that is associated with a project, but there are risks that are associated with a project. For instance, if we are an educational institute and we are undertaking a project in the insurance industry or in the finance industry, or we are entering into another business, then when we are appraising that decision, when we are appraising that project, we need to look at the risks that is in that particular industry. So we're going to be taking into consideration the risks there. So this is where we're going to be going back to what you learned in sources of finance or business finance beta. So we're going to be going back to beta to look at the issues about equity beta, asset beta, to look at how we can incorporate risks when we are appraising a project, because it's very important. As I mentioned, if an educational company is undertaking or starting a business, and that is in a financial industry or in the banking industry, then we need to not appraise the project at our current cost of capital, because our current cost of capital does not incorporate the risks in that industry. So diversification comes with risk. So we are going to see how we can incorporate risks into the investment appraisal process, because that is very important in relation to that. For advanced financial management, that is a very key aspect that we need to understand. But what you have to understand is that when we are incorporating risks, you need to understand that we are always going to be dealing with what we call the equity beta, the asset beta. Okay, we are going to be dealing with the asset beta usually, all right, the asset beta usually, which is the riskiness of that industry we are going into. So in doing that, what we do is that we have to look at the asset beta of a company already in that industry and use it to get a new beta for us, and use it to get a new capital asset pricing model. So fundamentally, when we are incorporating risks into projects, we are going to be using the capital asset pricing module. And in the next sessions of videos, we are going to be discussing how these risks can be taken into consideration, and how we can move from or how we can look at diversification, and also take into consideration how we can incorporate options when we are appraising a project. Because one of the things that you need to understand also is that companies would have options. Like for instance, if we want to undertake a project, we can have an option to delay the project and take it at a future date, or we can have an option to abandon the project, or we can have an option to increase how much money that we can put into the project, that is a redeploy of the project. So we will look at how all of those options affect a business when we are appraising a project, because in practice it is not just about calculating NPV, it's not just about calculating duration, but it's about taking into consideration the risks associated with the project, taking into consideration the options available for us when we undertake the project, and also looking at those things and their effects on the project. And it is there that we can decide, yes, we can undertake this project, or no, we cannot undertake this project. So I'll see you in the next videos, that as we talk about those issues and how they affect businesses, and that is going to be a very key aspect for advanced financial management. So you make sure you stay alert for the next sessions of the videos, because they will play a key role in everything that we'll be doing later on in investment appraisal in advanced financial management. So I'll see you there as we talk about those things.